We get calls from people who just have no idea what's going on in their retirement plan, and they know they have to do something, they know they need a change, but they don't know what to do or where to go, and that's why they're calling us.
I think the main draw is the concern to run out of money, and I think they're looking for some type of answer. You're not taking double-digit losses, you don't need double-digit gains. Is an extra 5% really worth risking your whole retirement on? When you remove the emotions, it's an objective situation. It's not opinionated. Here's the money that you have. Here's what's at risk. Here's your liabilities. Here's the gap. What do we do?
Hey, everybody. Welcome to the Greenlight Retirement Show. I'm your host, Brian Lindbergh, and we're here with Tim and Corinne Fitzwilliams. How you guys doing?
Doing well. How are you?
I'm doing good.
Awesome.
Good. Great to be here.
And as always, this educational show is not intended as financial advice for all you listeners out there. This is just some good information for educational purposes only. Some of these stories may sound like you, and they very well could be, but it's not necessarily financial advice. Work with your financial person.
They very well could be.
Yeah. Work with your financial person to make sure that it's a good fit for you before you act on any of this information today. But that being said, we wanted to go.
There we go.
Yeah, we wanted to go a different direction. We normally talk about markets and current events,
Sure,
and
yeah.
nobody cares about the market right now. It's going sideways. The market recovered back a little bit.
It doesn't make any sense, right? There's no real fundamentals to it. There's nothing really there. So we're just kind of coasting, and thank God we have a chartered financial analyst looking at our portfolios for our clients and ourselves to make sure that it's being followed appropriately, because it doesn't really have a real track to it right now. There's no real traction, if you will.
Well,
it's just
right
out
now,
there.
the market terminology, we call this like a melting up. There's not a lot of fundamental improvements going on right now.
Right.
But the market is tending to move in the upward direction, at least from where it was. It's sideways from maybe where we started the year at for the most part. Kind of range bound is another way to say that. But we wanted to take a pivot and talk about a different type of experience and a different type of investment. And I say experience from the perspective that this is something that Tim and Corinne do. But real estate is a very popular investment. There's a lot of people online that are talking about real estate investments these days. Some folks even have radio shows out there talking about real estate investing.
Yeah.
And I know you guys, you have your own investment company, right?
Oh yeah, we definitely live it. The good, the bad, and the different. Yeah.
Well, I thought it was only good, right? Real estate only goes up. Real estate agents drive around collecting checks and Cadillacs, and investors drive those Bentleys and Rolls Royces, living on all of our rent checks, right? That's how it works, huh?
It can become that way, but in general, it's not that way. So there's a couple ways to look at it. A lot of people, when they talk about real estate, they're not really in it, and they have like one or two rental properties. To me, that's dangerous. Your risk is too high. And AC goes out, you lose all your profit for your whole portfolio, right? Mm-hmm. So you got to have like 10 plus to really, really start, in my opinion, seeing the flow as a business model.
Well, we got to get to this, but how do we even get there, right? You got to have one before you have two, and two before three, and three before 13.
Right. So you got to buy them, right? And so how do you buy them is the question. And I think it's about what you're trying to accomplish. And so the idea is to buy them right.
Sure.
I don't understand how people buy retail residential homes or
something on the MLS.
Something on the MLS, and think that they're going to make money off of it, and they're excited because they have someone else paying down their mortgage. What they're forgetting about is, what about if an AC goes bad, or the plumbing, or this, that, and the other? Then now you're just negative. So how you buy is where it starts. And so there's a lot of information out there online and on podcasts and everywhere. So I'm just going to copy and paste all that stuff right here.
Yeah.
Or at least a portion of it, called the Burr method. The Burr method is a really hot subject right now.
And if you're out there Googling, that's BRRR.
To infinity.
To infinity.
Yeah.
Go look it up for yourself. Again, this is just some information about what's out there.
Yeah, I mean, again, not advice, just information, how I did it, right? But it's not perfect. Nothing's perfect, first and foremost. Nothing is just going to work out where all of a sudden you're making all this cash flow like you read about, and you know, it just was an easy thing. In fact, we'd always like to say nothing worth having is easy to obtain. Now, with that said, following the formula, I would go like this. You have your B, which is your buy. So you have to buy it with cash, but you just don't go out and buy something in cash in your name. And this is where a lot of people, Brian, mess up. Now, this part is somewhat simple. All you need to do is create a company, right? And so for us, it's Fitzwilliams Real Estate. We have our company. That's our family company that has our holdings in it for real estate. And so you create a company and then you buy with cash in the company's name, right? So now this company owns this jacked up property. And by the way, the more jacked up, the more dilapidated, the more problems.
Sexy the opportunity is.
The sexier the opportunity, right? We had one place, remember, we called it the Caca House. You remember that?
Yeah, what happened there, Corinne?
Within reason. When we say jacked up, I actually don't like when you're looking at houses that have foundation issue. Although you have purchased them and proven me wrong. But I prefer houses that are messed up on the surface, but still have good bones.
A lot of cosmetic and maybe a little bit more work. Yeah, and you're not wrong. I think that's the best opportunity, but sometimes it can get a little deeper. But for a new person, I would never do that.
Early in our adventure into real estate, mind you, I was not on board with getting into real estate. I prefer finance. But he said, we got this house. We got to go look at it. But grab some trash bags. And I'm like, okay. And we show up at this house and he starts tying trash bags around his legs. And I'm like, what are you doing? And he goes, you're going to want to put some bags on. And we cover our legs in bags. And I'm talking like, not like grocery store bags, but like
55-gallon black trash bags.
Yeah, contractor bags.
Yeah.
And we're tying legs up, bags around our legs, like big bags. And
We're talking above the knee.
we get to the door,
Yep.
and when
It's
you
a fashion thing. If
go
you look
to
at it
push
nowadays,
the
it might be
door
popular.
I
open,
think I saw that.
the door is literally pushing feces out of the way.
Yeah,
Oh.
yeah, that was the Caca House.
So this gentleman had purchased a house, and he
Oh, yeah, the brother and sister got mad at each
had
other.
a sister that was also on the deal with him, and he put all this money into fixing up the house because he was the one
Yeah, he did
living
new
in
AC,
it.
new floors, yeah.
New AC,
roof,
new floors,
windows.
new windows. And the sister, who hadn't put any money into the property, expected him to split the profit with him.
Yeah, 50-50.
And he's
yeah,
like,
sure.
what about all the money I put into it? And she's like, well, you got to live there. And he's like, oh, bet. And he had 6 dogs, 3 cats, I don't know how many hamsters and whatever else. And he was just like, you know what? I'll move out. And he let his animals live in the house.
Yep.
Yeah.
And I mean live in the house. And it was horrible. Even the contractors we use were out there with like double masks and putting essential oils in their masks. And I looked at that property and I'm like, Tim, no, we're not buying this. And, you know, our little friend that does the construction work, Pedro, he goes, this is the Caca House. Caca
Yeah.
House make good money. And we're like, what? And he goes, nice bones, good this. And, you know, my big thing about getting into property is our company name has our name on it.
Right.
And I don't care if it's a 500 square foot, 1 bedroom, 1 bath, or a 4,000 square foot, 5 bedroom. I will not let any of the houses that we buy not be up to our standards.
Yeah.
So when we walked into that place, I was like, this will never be a house up to my standards. The Caca House? No way. So it was amazing to see like what these guys can do when they come in and they rip off the walls and they start at
Right.
the bones and they built this, you know, beautiful home out of
Sure.
caca.
Yeah.
That's right, right. And that's the B, right? That's the buy. So you got to buy a house right.
caca.
Yeah, you got to
So-
find your own Caca House. You got to
I
find
see your
the
future
B.
like billboards out there, like we buy poopy houses, like
There you go. Yep.
kind of a thing. So
Now-
that's the trick.
The
I
trick is
think you
also
should
using
avoid
cash.
fire houses and flood houses, but that's just my opinion.
Yeah. Unless you get into it and you're advanced and know what you're doing. But
Well, it sounds like some of these more extreme cases, like if you know if your brother is a foundation person, or if your
Sure.
sister works at ServPro and they can do all the remediation type stuff, maybe you have a competitive advantage, to use an economic term. Maybe you have
Right.
a competitive advantage in some of those things to be considered for sure.
yeah, but in either way, you want to do it with cash. This is the key here. So you're buying with cash. You're not trying to do a traditional loan. You're trying to buy it with cash so that there's a zero balance. That's the B. Then, what Karim was talking about is the R, the first R, which is rehab. So now you're rehabbing the said property. You're spending cash to do that as well, and you're getting it to where it needs to be, what's called after repair value. So this is the market value of the home, if you will.
Now, a lot of times when you're in that buying portion of buying a house, it is very important to ensure that you have a home inspector that can go and do a walkthrough of the house and tell you all of the problems that he sees, because he's got a better eyesight when it comes to that kind of stuff and can kind of help you understand where your costs are going to be and where your pain points are.
Yeah, until you have a relationship with a contractor that you can trust and know. Yeah, I think that's a great point. When you're just starting out, having an inspector to come through, that's really going to tell you what you need to do.
So but worth the extra money to have a private appraiser, basically.
Yes.
But sometimes it can be difficult because people don't want to give you inspection terms if houses are like that. And so ultimately, it's best to have your own contractor just go out, because here's what's going to happen. You're going to have like a couple of days to do your due diligence. And when you write your offer,
go quick when it's
they
cash
go super
deals.
quick. Everyone thinks, "Oh, I'm nervous to get in." You got to make sure you can even get in. There's so many people.
You don't even have time to be nervous.
Yeah, you don't. So you have to make the game go quick. So that means you show up with the contractor, you walk the house, you do your analysis. You may be blessed and lucky enough to be able to have the time to have an inspector, but chances are you won't. So if you can just get in there and get your inspection done to your terms, at least you know what you're doing. That's why it's imperative you trust whoever you're working with on the contractor side. So with that said, it's now been rehabbed. It's now at full appraisal value. Remember, it's in your company name. So what are we going to do? We got to create revenue. We're not trying to flip it and sell it. We're trying to create revenue. So we're going to put a renter in there. And so when you put a renter in the property, where a lot of people mess up is they say, this person, I'll just use simple math, this person's paying me, $1,000 a month, and my cost is, my mortgage is $500, so I'm making it really easy. My net is $500, and that's not right. And that's where a lot of people mess up. So you have to prepare yourself, because for the next step, you have to follow a formula. And so what you want to do is you want to take your gross rent, and you're going to want to subtract 25%. And that breaks down to like 10% for property management, 5% for capital expenditures that you may need to fix up the property with, another 5 or 10%, depending on how things look, for miscellaneous and vacancy.
Take a quick sidestep. So this is your formula that you use, right? Now, there's going to be iterations and derivatives of said formulas out there.
Yeah.
You got to know what formula is right for you ultimately.
But it matches because I like to make it simple on myself. My formula matches the DSCR requirements for most of the banks. And that brings us to the next step. After you rent it, now you refinance it, but the refinance is different than what you're used to, because now you have an asset that's making money.
Yeah, I want to slow that part down real quick, because earlier you said you buy the house cash. I think some of our listeners might have got confused when you said rent and figuring out this, 75%, 25% ratio there based on having a mortgage. I knew the next R coming up was going to be refinance, but it sounds like these two steps are fairly married together. You need to know your math on what you can rent it for, get a contract for rent, because you got to know what your mortgage, future mortgage.
Before you purchase the house, you need to ensure you know what it fixed up will rent for.
Yes.
And you need to know what your cost for the house and cost for repairs are going to be,
and your loan to value, how much the bank will give you, to ensure
that you're getting enough money in your loan that you're paying yourself back, but also that you're not ending up with a mortgage payment that's upside down. You don't want to have a property where your mortgage payment is $1,200, but you're only going to be able to rent it for $1,000.
Sure.
If that's where the math comes out, you're walking away.
But that's this. I think most people get that part. I think it's the deeper part. They're not subtracting the other percentages. They're not subtracting 10% for property management. Now we're running a business, so we're not talking about doing it ourselves, right? You want to work smarter, not harder. You want other people to work.
You're
for
eventually, if you get to the 10 to 15 houses, you're eventually hiring
you
a
want it to be
property
that way,
manager.
right? So you got 10% for the property manager, like I mentioned, 5% for capital expenditures, 5% for vacancy, and 5% for miscellaneous. And this is what. And I don't want to get all nerdy into like what the true definitions are, but let's just leave it at that and say that formula is what the bank is going to look at. So let's translate it to what Corinne was talking about.
Hold on, one other thing. When you mentioned the R stands for refinance, and that threw you for a loop, it's still technically a refinance because you're paying yourself back. You are currently the mortgage holder.
Sure, yeah.
If you can do the
used your
math right.
cash.
If you could do the math right. And that's kind of what we got to, that's what I was trying to say, is that with Corinne's example, she's talking about paying yourself back, but that's where that formula comes into play. See, because the refinance is now based on the profitability of the property to the bank.
Sure.
They want to know that it's profitable. And that's where they have that DSCR ratio that you have to follow.
And
so
DSCR for everybody's debt service coverage ratio.
Right.
That's what the bank cares about. Are you going to be able to serve it? Can you cover the debt service? Are you going to be able to cover the mortgage, have enough profit that you won't go out of business so the bank can depend on getting their money back?
That's right. And so now you're looking, when you go to buy the property, so we're going back to the beginning, you're looking at that ARV of what it could be at. You know what the bank is going to be willing to lend you, 75%, 80%, right in that range normally.
ARV after repair value?
Yep.
Okay.
And then, so you know the ARV, you know what the bank's going to lend you, that's the loan to value, and then you can subtract your rehab costs and your acquisition, and that'll show you where you're at. Now, when you're doing this refinance, you're going to get what the monthly payment's going to be, the mortgage. And when you do it as a corporation, it's not going to include taxes and insurance. It's only what's called PI, principal and interest. What most people are familiar with is PITI, principal, interest, taxes, and insurance. So in this model, we're just going to get the PI. We got to research and figure out our own TI. But once we do that, we put it all together and we get our basically our normal mortgage payment as we would look at it. So remember, we take the gross rent, we subtract the 25%, then we subtract this mortgage payment that is full PITI now, and that's going to give us our true net. And that net, if you do the Burr method, because you're sucking out enough cash so that you play a game that you get the majority of your money back that you put out in the beginning, or all of it back, but still make a little bit of profit. It's about $200 to $300 a door. That's the goal with getting the majority of your profit back. And that leads us to the final R, which is to repeat.
Let me restate then, so we can kind of bring it all home for those of us who might have got lost in the sauce somewhere in the middle. It has a lot of good stuff. So when you're thinking about buying an investment property, you're first going to be looking at what you believe it's going to be worth when you're done repairing it to your standard. Then you need to subtract the amount of money that the bank is not going to be willing to loan you, which is the loan to value, which is somewhere between 70 and 80%, depending on the bank or the institution that you're working with. If your
That's the amount they will give you.
Yeah, 70 to 80% loan to value. So let's call it 75% loan to value, which means you have to, if your house needs no repairs, no nothing, it's turnkey, you can only afford to pay 75% of its value in this model. Now, that's not these case scenarios because you're going to have to fix it up. So then now you've subtracted the 25%, you subtract your rehab.
That's right.
Your rehab cost, it's going to cost you $50K to fix it. And now you have your offering price, right?
Exactly right.
And so now you've offered, let's assume that they took your offer, so your purchase price plus your rehab is equal to 75% loan to value.
So real close.
And in this perfect balanced equation, what I hear you saying, and I want everybody to hear clearly, is if you can balance this equation perfectly, Tim said earlier, you almost never balance it perfectly, but theoretically, if you balance it perfectly, you get all of your money back. You can collect the rent check and make a few $100 a month.
Yes. And so since you get all your money back, you go and do it again.
Now, I will tell you pitfalls that we've seen other first-time or newbies fall into is if you buy a home that is dilapidated enough to where you're getting it far below value, and you put money into it and you fix it up, and its value is then really well. When you go to get 75% loan to value, you might get a lot more than what you put into it. You might get $40,000, $50,000, $60,000 more than what you put into it as a option. You don't have to take all of that money out, because then you might end up with this bigger mortgage than
Right,
what
your profit won't be there. So there's two sides of that coin, Corinne. She's absolutely right. If you're just looking at the profitability of the monthly rental, then yeah, you want to only take what you need. However, what's super cool about taking more is what? You don't pay taxes on it, because it's tax-free, which is kind of cool. So if you wanted to look at it from that aspect, that's a unique way of doing it as well. But either way, I think we get the point here. You're buying it at the right price.
Buy it at a discount.
You're putting it in a company name, and then you're fixing it up. You're renting it. You're going to a bank and you're negotiating. And here's the benefit of doing it in the company name. They're going to look at the profitability of the house and not at you. Mm-hmm. I mean, you may end up being a guarantor, like a personal guarantor, but you're not. Your credit, your debt to income ratio is not going to be the thing that decides whether or not they want to do business with you or not. Mm-hmm. They want the house because the house is profitable, because you've made it that way. It has zero debt in this conversation, and it has a renter. It's a beautiful deal.
It's a productive asset, I've heard you say before.
Yeah, it's a producing asset, yeah. So the bank runs their formula, and if you follow my formula, it matches the bank's, so everybody's happy. And then you're set. And I think if you do that a few times, so that's what we did. We did it multiple times, back to back to back to back. I'm partnered here locally with a company, and CPR is the name, and we buy houses with that point. Is we try to find dilapidated houses, and we either keep them for our personal portfolio, or we try to flip them. And if you do it right, you can continually do it. Mm-hmm. It's something that can really grow into something. So then you talked about in the beginning, like, can you sit back and have the cars and do all that? Well, it's not so much like that in the beginning, but what it is like in the beginning, 4 houses in, $1,000 extra profit a month. You know, we're in Vegas for this business, for the financial business, at a conference. And, you know, we kind of very cautious when we spend money, just because we just always are. We end up doing it, but it's like we really kind of do our it's like how you would just think it a people that own a finance firm would be. They're going to analyze it, look at the cost of benefits, establish whether or not you should have it. So, Corinne, tell them the Jimmy Choo story.
We've already used that on the radio, haven't we?
I think we have. Yeah, but it came from this.
So I do the not property management. We have a property manager, but I do the accounting and the keeping track and dealing with all the annoying stuff. And so when we had this profit that was coming in, it's sitting in this account, and we were out in Vegas, and we were just happened to be going into a fancy shoe store because
just window shopping.
But what's interesting is Tim and I are polar opposites. He's fine china, I'm paper plates. He's wearing Prada shoes, I'm wearing Target shoes. That's just how we always have been. And so for the first time ever, we're going into a shoe store, and I'm the one looking, because even though I don't want to wear $1 million heels, what girl doesn't want to try on a pair, you know? Mm-hmm. So we went into the store, and I'm trying on a pair of heels, and they were like $600. Mm-hmm. And I was like, Jiminy Cricket, $600 for a pair of shoes. Never in my life would I spend $600 on a pair of high heels. And Tim was like, it's free money. The money's going to spend it. I mean, it's not something that we need, the money.
Well, because it came from the rentals.
You know, why not spend it on something fun for yourself? And I don't know how much I had drank during that Vegas trip, but we decided to buy me a pair of $600 heels.
Oh, and then fast forward, right? We started to build the company and have more cash flow like that. So then all of a sudden, what we were able to do was start doing more things for fun, taking different types of vacations, buying watches, stuff like that, spending. And I think that's a really good financial topic.
Okay.
Spending out of our cash flow to buy things that we wanted.
Yeah.
Not out of our cash. That's the key.
So, Tim, that's a big comment right there. You don't spend your assets, you spend your cash flow. Although your assets are accumulating, which is what everybody wants. We all want to see a bigger number in the investment accounts and our net worth, more in our bank accounts and so on. But what I hear you saying is what you two care about more than anything is just the monthly income, even if it is more nominal, like a few hundred extra bucks a month. But you're just saying, well, stack that and then stack that and stack that. Next thing you know, you got a couple thousand a month and then maybe 10,000 a month, and it keeps growing. Talk to me about that strategy, a little bit of cash flow.
Well, yeah, you try to stack cash flow because it continues to keep coming in. And then if you don't need it, you can reinvest it. But the idea is to spend frivolously out of your cash flow, not your savings for emergencies, not your money that you have designed to grow.
Sure.
So one of the things that's interesting to me is when you poll retirees and ask them what's most important to you, how much money you have in your bank or how much money you get each month.
Sure.
Most retirees care more about how much money they have each month to spend. Like there's this fear of running out of money. So they're constantly trying to make sure that they're not spending more each month than what they need. And they're trying to calculate, how long am I going to live? How long do I have to make this last? But if you can take your money and make it grow for you in the amount that you need each month, then you're not going to have to worry about running out of money because your money is not what you're spending. You're spending your profit.
Well, it's just like we call that critical mass.
Sure.
So it's just like the real estate example. So once you have 10 properties and you have the cash flow coming in, now if an AC breaks, whatever, the cash flow will pay for it. See?
Because the chance that all 10 are going to have their
It's
AC
not
break in
gonna
the
happen.
same month.
And so then when you go from 10 properties to 15 to 20 to 25
You
to
got
30
it.
to 50 to 100.
You minimize your risk. As
And then
weird as it
eventually,
sounds.
and then eventually you hit the other side of the critical mass where your passive income can now support all of your family's fixed and
Yes,
discretionary
yes.
money. And then what I hear you also saying is above and beyond that, should you continue to push it and the blessings continue to roll, you'll actually be able to afford some luxury items out of the cash flow of the company, not the assets of the company.
Well, not just
Right.
that, but if you make this hobby something you enjoy and you're successful at it, another great idea is after you've built this little bucket of properties, if they're all in the same area, sell off the book of business.
Now you have cash.
And then you have a large amount of cash that you can reinvest into more places. You don't have to sell all of them off, but you're allowed to, keep the properties you want and sell off the ones you don't.
Absolutely.
Yeah, it gives you, and there's always natural appreciation too. So it's an interesting model to do that. But in general, I like the idea of cash flow is king,
Yes.
not cash. And so with that said, and Corinne was saying people are scared that are retirees of running out of money. They're scared of running out of money. I think around here, though, it's not so much the case because there's a lot of pensions. But you know what they're scared to do? They're scared to live. They're scared to have a budget. They think somehow it's a trend to be cool to not spend a lot of money per month. Look, if it's out of your cash flow and you have the money, why not? Why not do these things? Like I can think of one of our clients who has plenty of money, plenty of cash flow, never went on cruises, never vacation, never did any of that stuff. And now because we've established a proper mindset, they're going on vacation all the time, right? They're having a great time going on cruises they've never been on before, which is amazing. So the idea is don't be so tight.
Sure. Well, don't be so tight. Be tight with certain things, right? Protect your assets.
Yeah, protect your assets, but don't be so tight to
income-producing
spend the
assets.
cash flow that you have.
Yeah.
Or maybe here's a wild thought that we like as a firm. Let's build more cash flow out of your assets as you are getting older so that you can live more because you only get one life.
Well, let's talk about that a little bit. So Corinne made a comment. You sell yourself out of real estate. You got a bunch of cash. You realize and appreciate the fact that life is built on income and cash flow and not asset values. So what are some of those other ways that we can produce income? And is there a way where you can produce income here, like passively, kind of like the
Right.
real
That's
estate.
I
where we get
know.
into the different financial products. Yeah.
I know you two are more of the stock market side of the house, but I started from the ground up with life insurance and annuities. So one of my favorite ways of creating an income source for somebody is still a quality annuity. There are annuities out there where you can put in your money, whether it's qualified funds or non-qualified funds, and create an income source.
Yeah.
And then there's options where you can choose, do you want it to just be your life or for the length of you and your spouse's life? And there's options where you can choose whether or not you even want to start the income at a certain age. And it's not, and you can still have like the 10% penalty free or 7% or whatever their penalty free withdrawals all are if you need more income than what you had originally accounted for. But I think annuities are often given a bad rap because the wrong products are sold by the wrong people.
Yeah, that's a good
Absolutely.
point.
No, really good point.
Yeah.
I think it relates back to to talk a little bit about this. When you are selling out of the real estate, I think it's important to know from a financial planning perspective what your distribution rate is, your net distribution rate, what you're actually making net of taxes, net of ACs breaking, net of all this. And if you've been doing it long enough, which you were in this hypothetical scenario, you'd be able to get an average of what that is. And you can figure out what that distribution rate is, because now when you get your net after tax money from selling your book of real estate business or assets here, you need to know what percent income you need to derive, the distribution rate you need to derive from that lump sum that you have. Now, Corinne mentioned you can absolutely look at it from an annuity perspective. On the market-based side, you can look at it from a dividend rate perspective, where you could have either a higher dividend or interest rate paid at a more aggressive rate. You could have income and growth, which is a combination of maybe a lower distribution rate with a little bit of capital appreciation. That's something you really work with, an investment advisory team like we have that I lead here at the Fitzwilliams Wealth Management team, where we can look at those market-based. Corinne mentioned and Tim are mentioning these non-market-based models, but we bubble it all back and bring it all back to what's the distribution rate that you need off this asset to live your life, to have that cash flow.
Yeah, and the rule of thumb is the 4% rule, but it depends. If you are of the mindset that I don't want to leave an IRA to my kid because it's the worst dollar I can from a taxable standpoint, then you can maximize that 4%. You can make a whole lot more. And then if you don't spend it, Brian, just reinvest it into a better tax qualified position.
Yeah, absolutely.
So I'm really a big component of getting as much income out of your assets that you can that's suitable, right? Try to take that to the maximum, because if you don't need the income, what's the worst thing you do? You just reinvest it back in the market, but at least it's at a better tax qualification.
Well, and if you structured it right, it sounds like you have the ability to spend it. And if you've balanced it right in your financial plan, you don't really necessarily need to reinvest it. But what I hear you saying is like, hey, you don't have a vacation this month, might as well reinvest it for the short term or until I can spend it again. But guess what? That next paycheck is coming. I think that's what is most scary, and we talked about this before, for the pre-retiree today. What happens when I get that last paycheck? How do I make this money last?
Right. How do you make it last? If you don't have the pensions, how do you make it last? And that's where you want to develop a private pension or a good financial plan that's going to give you the income that you need. And I would always be a component of get a little bit more than you need so you can feel comfortable and live your life and not feel penny pinching in the years that matter the most.
Yeah. I mean, we have some team members here that like to talk about, when are you going to be best capable of spending the income? I know a lot of people, their financial plan revolves around deferring Social Security till age 70, not taking any money out of their IRAs until they hit required minimum distribution ages. But folks, if we're waiting until we're 70 or 75, even in some scenarios, to take any money out of our savings, what's our quality of life then?
That's what people don't want to talk about.
God bless you. If your quality of life is great.
Can you get on that cruise ship? You know, and are you able to go to the bar and enjoy a drink with your spouse or your friends?
Take the excursion into town.
Exactly. It becomes real.
We did have an 82-year-old on the last excursion we went on.
We were in Mexico, and they were doing the zip liner, which was awesome. That was awesome.
They were, grandparents who worked their whole lives and just kept working and never did anything except make money. And finally, here they are, 82, and they're out there
And
doing
they're blessed to have their
ziplining.
health, but what
I was
about the
gonna say-
82-year-olds that don't have it,
There's far more, unfortunately,
that are
Yeah.
not ziplining,
that are not ziplining at age 82,
especially
Very
in
true.
America, I'd say.
Yeah.
especially in America.
Now, going back to what we were talking about as far as ways to ensure that you have an income and all of this stuff. Another thing is, let's say you have properties and you're creating an income source and you don't need as much money as what you're making. What a horrible blessing, right?
Yeah.
Another thing I want to bring up is thinking about your future. You could always take some of that money and put it into a life insurance policy to ensure that, God forbid, something
The
happens
legacy.
to you.
Yeah.
Yeah.
You
I mean, to pass it on to your kids the right way.
so they can afford the
Right.
taxes.
Yeah.
They can keep the mortgages up. They can. So I think another important aspect, and that's why we aren't a one-stop shop. We're not just selling, put all your money into the stock market. We're not just sitting here saying annuities are the way. It's about taking everything and weaving together this picture that is beautiful.
Blended approach, right? A balanced approach, but with a real concentration on a focus on income and conservative approaches. And to your point on life insurance, I made the comment earlier that leaving an IRA is the worst tax dollar that you can leave to your kids. Well, what if you could start to convert that IRA, use the cash to buy life insurance? Now you've created a legacy that's tax free. And it has benefits for you while you're alive as well in some cases. So it's a lot more than what people grow up hearing about or reading about.
Yeah.
That's the problem, is that things get a bad rap because people don't take the time to do the research themselves. And when I say research, I don't mean a quick Google search just to try to get an opinion from Reddit or some random person, but actually understanding how it works, what the models are. And that's why you have to talk to a fiduciary, because they are going to tell you the good, the bad, and the ugly of everything that you do. And that's how we built our firm, is to make sure that fiduciaries are speaking with you on the topic and not trying to sell you, but rather trying to educate you. And if that leads to a sell, that's fine. But the idea is that you're educated and you make an informed decision.
I can actually, you remember back when you used to have our radio show, I used to always use metaphors. So I wanted to say this real quick because we already talked about my Jimmy Choos that I bought, right? I was so excited to buy them. And I tried them on, walked around the store for like 5 minutes, and I bought them, and I loved them, and I was so excited. But I bought them half a size too small.
Oh, no.
So now I love them, but I don't wear them as often as I could because they're not comfortable. And with annuities and life insurance, it's very similar. It could be a Jimmy Choo level company, but you might be getting the wrong size.
Yeah.
Yeah,
And
how
it
you
can
build
be
these things
uncomfortable.
matter, right? How you
So-
size it,
That's
yeah.
deep.
It's
That's deep.
it's important to make sure that when you're talking to a financial planner that they're going to make sure it's the right fit for you, because they can show you the best company out there, but if they're showing you a size that's too big or too small,
Yep.
it's going to hurt you.
And don't get sticker shock. Don't get all excited because you see some fancy, cool-looking bonus.
Yeah.
Bonuses are great and they have a place, but don't make that be your deciding factor. Understand what the underlying product is going to do for you. If it has a bonus and it does what it needs to do for you, that's fantastic. But don't let the bonus be the deciding factor. And we don't have time today, but they don't work the way
Yeah.
that most people assume that they do.
I totally agree. There's a lot there. What I like to wrap up with, at least on that part of it, is just, you made a key point there, Tim, is when you're working with a fiduciary firm who has the obligation to reflect the duty of care and the duty of loyalty to you, making sure that this is going to be the best recommendation for your family, and doing so from a position of education, so that way you can understand it well enough to make an informed decision for yourself. Additionally, I also like to say and add on to that, insurance is what an annuity actually is at its core. And when we purchase insurance, it solves a problem. We buy car insurance because we're concerned about the cost of a repair. Should we get into a wreck or that dump truck flick a rock at our windshield or something like that? So we have to offset our risk somewhere, but it's solving a problem. I was looking at a case earlier today. They're asking me questions on this $20,000 annuity relative to a $3 million portfolio. I'm like, folks, I love you, but you were sold here. Like,
Yeah, what did this do for you?
like, tell me the problem.
What
that
level of
this-
diversification was
What
that?
level of diversification?
Yeah.
Tell me what problem this $20,000 annuity solved relative to your $3 million net worth. I don't even need to know what the company is. It could be a Jimmy Choo level company, to Corinne's point, but it was, you know, I don't want to throw brand name shoes out there, but it was Budget Shoes R Us, basically.
Yeah.
Execution. So if you're out there shopping for insurance or annuities, just make sure it's solving a problem for you.
I think that's key. Yeah.
Otherwise, don't
just-
do it. It doesn't have a place if it's not solving a
Right.
problem. It's a product at the end of the day. Products solve problems.
It's for a solution. That's right. And if it doesn't fit your solution, then you don't need the product. It's real simple. It's not about are they good, they're
No,
bad.
it
I
really
mean, they're
isn't.
bad. They'd be illegal and off the market, and you wouldn't even be able to get them. So the idea is that they are available and they are a tool. Much like tariffs, they can be good and they can be bad, and it depends on your need. And so, if you have a need for income, if you worked your whole life, you're making $200,000 a year, and you saved up $2 million in your 401k, you quit your job, you retire, you're not getting a pension, you get a nice handshake on the way out, maybe some cake, and guess what? How are you paying your $10,000 a month bill? How are you paying your $20,000 a month bill? Because if you're making $200,000, $300,000, your bills might be $20,000 a month, $15,000 a month. That's not uncommon. So if that's the case, how are you paying it? How long is your 401k going to last? Put your mind at ease, go see a fiduciary, and see what it would take to make some of that money go into a model that would be guaranteed to give you that income. And that's a good fit for an annuity, right? Or if
Absolutely.
you want to diversify and look at it as maybe a different strategy other than the stock market, then it can be a conservative approach that can do really well. Sometimes they can make as much as what the market does on the bond side. So it can be an alternative to that. And it's just about what you're trying to accomplish. But I think the main thing is be open-minded. And really on the spending side, it's okay to have more income than you need.
Yeah. Absolutely. Well, we'll leave it here for now, folks. Thanks for tuning in to the Greenlight Retirement Show, and we'll see you next time.